China just put a lock on silver, and it happened so quietly that most people will only notice when something they rely on gets more expensive, delayed, or quietly redesigned. In the last days of December, silver didn't just go up. It went vertical. It printed fresh records around $79 an ounce on Friday, December 26, 2025. And then on Monday, December 29th, it briefly crossed above $80 in a violent whiplash move that looked less like a calm market and more like a crowd trying to get through a doorway that suddenly got narrower. The strange part is that you were supposed to hear a loud alarm when something like that happens, because silver is not a nice-to-have metal. It's a system still works metal. And here's the promise I'm making you right now, in plain terms. By the end of this episode, you will know exactly what that lock is, how it changes the flow of real metal, which industries get billed first, which stocks quietly benefit, which stocks quietly bleed, and the 3 signals that tell you whether this move is a temporary stampede or the start of a longer squeeze that rewrites supply chains into 2026. But to get that payoff, you have to see silver the way the real economy sees it, not the way a price chart sees it. Because a price chart is like looking at a city at night from an airplane. You see the lights. You don't see the power stations. You don't see the grid. You don't see the single transformer that, if it fails, makes an entire neighborhood go dark. Silver is that transformer. Most people still talk about silver like it's just the little brother of gold, like it's a cheaper coin, a shiny relic. Meanwhile, the real world has been turning silver into a conductor for everything that wants to move electricity fast, clean, and reliably. And that is exactly why a quiet export gate matters more than 1,000 loud headlines. So let's start with the lock. China's Ministry of Commerce issued rules for 2026 to 2027 that tighten who qualifies as a state trading exporter for silver and what standards they must meet to get that status. Read that again slowly, because the wording is the trick. It's not a dramatic ban. It's not a billboard that says no exports. It's a gate. And the key is paperwork, qualifications, and permission. In China's announcement, a new applicant producer for state trading silver exports is tied to thresholds like having 2024. Silver production of 80 metric tons or more, with a lower threshold in the Western region. 80 metric tons doesn't sound emotional until you convert it. That's roughly 2.57 million troy ounces. That's not mom and pop output. That's industrial scale. That is the difference between a wide open road and an authorized vehicles only lane. And this is why the market is reacting the way it is. A gate doesn't need to close. It only needs to slow. It only needs to become selective, and selective friction is enough to turn a comfortable supply chain into an anxious one. Think of global silver as water moving through pipes. When the pipe is wide, nobody argues about the last drop. When the pipe narrows, everyone suddenly becomes an accountant and a lawyer at the same time. That's what licensing does. It changes a commodity from available if you pay into available if you qualify. Now, before we talk about what this does to prices, you need one simple reality check about the physical market. In 2024, global mine production was about 819.7 million ounces. Recycling added about 193.9 million ounces. Put them together and you get roughly 1.01 billion ounces of supply. Total demand, meanwhile, was about 1.16 billion ounces. That math implies a deficit around 146 million ounces in 2024, which is about 12.6% of total demand. If you ran a supermarket with a 12.6% shortage in a staple product, you wouldn't call it balanced. You'd call it empty shelves with a polite face. And that deficit isn't happening because people are suddenly wearing more silver jewelry. The engine is industrial demand. The parts of the economy that don't get to skip a year just because prices are higher. Photovoltaic demand alone hit about 197.6 million ounces in 2024. Electronics and electrical demand hit about 465.6 million ounces. Those are not hobby numbers. Those are industrial lifeblood numbers. And the auto sector matters too. This Silver Institute has discussed projections approaching about 90 million ounces of silver absorbed annually by the automotive industry by 2025, because modern vehicles are basically computers on wheels. And electrification means more connections, more sensors, more reliability requirements. When you hear electric vehicle, don't picture a trendy car. Picture a rolling power grid with hundreds of failure points that all need high quality electrical contact. Now, let's connect this to your daily life, because this is where the bill shows up. You saved money when you chose the cheaper phone plan, the cheaper appliance, the cheaper charger, the cheaper everything. You saved 5% here, 10% there, and it felt smart. But you paid for it in fragility. You paid for it in just-in-time inventory. You paid for it when the supply chain decided that your product is not urgent and someone else's is. You've paid for it in delays, shrinkflation, thinner components, and products that quietly degrade in quality. This is how the modern economy invoices you. Not with one big scary charge. With 1,000 tiny charges you don't notice until you add them up. Silver is one of the metals that makes that invoicing system possible because it sits inside the connections, the contacts, the pastes, the coatings, the switches, the membranes, the solder, the catalysts. It's everywhere, but it's not obvious. And when something is everywhere but invisible, the market can underprice risk for a long time until it can't. That's why silver printing $79 and then briefly above $80 into year-end matters. You're watching a hidden input flash on the dashboard. Now let's talk about the second force behind the move, because the lock alone doesn't create a price record. The macro environment poured gasoline on it. The US dollar has been sliding hard in 2025, on track for around a 9.7% to 9.9% drop against a basket of currencies, the worst year in a long time. When the measuring stick shrinks, the measured object looks bigger. That's not poetry. That's basic pricing, physics. And rate expectations feed the same machine. Markets have been leaning into the idea of more rate cuts in 2026. And that kind of expectation pulls money toward hard assets. When cash yields feel like they go in dome, people stop treating dollars like a destination and start treating them like a hallway. Money wants a room to sit in. Meanwhile, the fiscal picture is not exactly calming. In fiscal year 2025, US spending was about $7.01 trillion, revenue about $5.23 trillion, and the deficit about $1.78 trillion. That means the deficit was roughly 34% of revenue and about 25% of spending. It's like running a household that spends $7,010 and earns $5,230 every month, and then acting surprised that the credit card balance keeps growing. Add the real economy context. The unemployment rate was around 4.6% in November 2025, with about 7.8 million unemployed people. CPI over the prior 12 months was about 2.7% as of November. That's not catastrophe, but it's not that everything is solved world either. It's a world where people feel squeezed, where policy gets political, and where commodities can move because trust moves. So silver is being pushed by two hands at once. One hand is industrial reality, the deficit math. The other hand is macro psychology, the currency and rate story. Now we earn the real payoff. What does the lock actually do to companies and to your positioning? Because here's the uncomfortable truth. When silver spikes, the first people who panic are not coin collectors. It's purchasing managers. If you run a solar manufacturing line, you don't care about silver as an investment thesis. You care about silver as a line item that can stop your factory. Silver paste on solar cells is not a philosophical concept. It's a physical input. And PV already consumed about 197.6 million ounces in 2024. So the question becomes, can the industry thrift and substitute fast enough to outrun tightening supply? The Silver Institute itself notes that PV loadings have been reduced through technological advances, which is hail, but the demand still hit a record. That's the treadmill problem. You can become more efficient. But if the treadmill speed increases faster than your efficiency gains, you still get thrown off the back. Now think about who gets hit. Module manufacturers and upstream silicon PV players are exposed to silver paste costs, but not all solar companies are equal. A name like First Solar is different because it's thin film technology rather than mainstream crystalline silicon, which changes silver intensity. On the other side, many silicon supply chains still rely heavily on silver paste, and cost pressure tends to show up in module pricing, margin compression, or design changes. Then you've got the companies that sit downstream but still feel the squeeze. SolarEdge and Enphase sell inverters and systems into a market where total installed costs matter. If modules and balance of system costs rise because inputs rise, it can slow adoption at the margin. Not always, because policy targets and energy economics can overwhelm input costs, but the sensitivity is real. Now look at EVs and autos. Silver isn't the biggest cost in a car, But it is one of those costs that can be negotiated away easily because it is tied to performance and reliability. If you accept estimates in the range that battery electric vehicles use roughly 25 to 50 grams of silver per vehicle, that's around 0.8 to 1.6 troy ounces. At $30 silver, that's roughly $24 to $48 of silver per EV. At $80 silver, that becomes about $64 to $128 on a $40,000 vehicle. That seems small, but multiply it across volume and it becomes a procurement headache. If you build 2 million EVs, that input delta alone can be roughly $80 million to $160 million. And that's before you count the knock-on effect of higher costs across connectors, electronics, sensors, charging infrastructure, and the grid build-out that follows EV adoption. Now, name the obvious players. Tesla lives at the center of EV energy storage and grid infrastructure narratives, so it becomes a symbol even if the cost line is not decisive. BYD, Volkswagen, General Motors, Ford, Hyundai, and the big global auto groups all face the same physics. Electrification increases electrical complexity. Complexity increases demand for reliable conductive materials. Now, consider semiconductors and data centers, because this is where people misunderstand scale. One smartphone may only contain fractions of a gram of silver. That sounds tiny until you remember that billions of devices ship into the world over time. And even where silver content per unit is small, silver is used in high-value applications where failure is not tolerated. Data centers are not built like budget laptops. They are built like airplanes. Reliability is the product. If you're Amazon, Microsoft, Alphabet, or the hyperscale ecosystem, your priority is uptime. You can't have a critical input constrained by a licensing gate. So here's how the economy responds. When a gate appears, big buyers do two things. They try to lock in supply, and they try to redesign around the supply. Locking in supply is immediate. Redesign is slow. That time gap is where prices can overshoot, and that's why silver can behave like this. It is not just being bought, it's being pulled forward from the future. Now we go deeper into the part. Most people miss the part that determines whether this is a one-time spike or a structural regime change. Silver supply is weird. A huge share of silver is produced as a byproduct of mining other metals like lead, zinc, and copper. That means silver supply is not purely a silver decision. It's a copper decision, a zinc decision, a gold decision. If silver doubles, but copper demand is weak, you don't magically get double silver. It's like trying to get more milk by changing the price of butter. They're related, but the cow doesn't obey your spreadsheet. So when demand grows structurally in PV electronics and autos, the supply response can be slow. Recycling helps. And in 2024, recycling rose about 6% to about 193.9 million ounces, a 12-year high. That matters. But recycling is also a lagging response. People recycle when prices are high and when they have scrap to sell. You can't recycle what doesn't exist yet. A solar panel installed today becomes recycling feedstock years from now. That's why deficits can persist and why the market can suddenly realize all at once that inventories matter. Now let's talk inventories in a way that actually means something. There are two kinds of inventory that matter psychologically. The kind you can point to and the kind you can actually get. London Vault holdings are massive. As of the end of November 2025, LBMA reported about 27,187 tons of silver held in London vaults. That's about 874 million troy ounces. On paper, that sounds like the world is swimming in silver. But that is like saying a library has millions of books. So you can borrow any book you want instantly. Try it. Most of those books are owned, allocated, promised, or not for lending. The number that matters is the number that is available at the margin. Without a fight, without paperwork, without delay, without a price premium. That's where exchange deliverable inventories become a psychological gauge. On December 26, 2025, CME's COMEX report showed total registered silver around 126.36 million ounces. Registered is the category that is deliverable against futures contracts. That's the available for delivery pile in the place everyone watches. And when that pile becomes a smaller and smaller fraction of the global flow, markets get jumpy. Not because they know a default is coming, but because they know the system is tighter than it looks. Now, do the perspective math Global mine production was about 819.7 million ounces in 2024. COMEX registered at about 126 million ounces, is roughly 15% of that. Global demand was about 1.16 billion ounces. COMEX registered as roughly 11% of that. If demand surges, or if a supply gate tightens, that deliverable pool can feel small, fast, and this is where the story becomes personal. You thought you owned silver exposure because you owned a ticker. You thought you had the metal because you had a statement. You thought you had the house because you had a picture of the house. But ownership is not a vibe. Ownership is a legal right to a deliverable thing under terms you understand. That doesn't mean paper products are evil. It means you need to know what you actually own and why you own it. Some people choose physical exposure. Some people choose ETFs. Some people choose miners. Some people choose options. The point is not which team you join. The point is that each choice has a different set of risks. Physical can have storage, premiums, liquidity. ETFs can have structure, questions, and tracking considerations. Miners have operational risk, jurisdiction risk, cost inflation, hedging, and dilution risk. Options have time decay and leverage that can destroy you if you treat them like lottery tickets. Now, let's name companies, because this is where the market gets real. If silver stays elevated, pure play silver miners can benefit from higher realized prices, but only if costs don't rise faster and operations don't stumble. Names people look at include First Majestic Silver, Pan American Silver, Hecla Mining, Endeavour Silver, Hochschild Mining, and Fresnillo in the UK market. Then you have streaming and royalty exposure where the economics can be different, like Wheaton Precious Metals in Franco-Nevada, where cash flow sensitivity can look attractive, but valuation can already price in optimism. But there's a trap here. You don't buy miners just because metal goes up. You buy miners if the margin expands. If a miner's all-in sustaining costs climb because energy, labor, equipment, and sustaining capex climb, the metal price tailwind can be partially eaten. A miner is not a bar of metal. It's a business with a balance sheet. Now flip the grid. Who gets pressured? High-volume manufacturers that rely on silver inputs but can't pass costs immediately can see margin pinch. That could touch parts of consumer electronics, automotive suppliers, solar supply chains, and any sector that lives on tight margins and large volumes. And then there's a third group that most people ignore. The quiet winners who sell the picks and shovels of the transition. Grid infrastructure builders, high-voltage component suppliers, connector and contact specialists, and industrial automation suppliers. Some of these companies have diverse input exposures, but they live where electrification turns into purchase orders. Now we're ready for the real reveal. The reason this lock matters is not because China is the only source of silver. It matters because it changes the rhythm of supply. At the exact moment industrial demand is structurally high and deficits have been persistent. It's like a stadium with multiple entrances. You can still get in, but if the biggest entrance becomes a checkpoint, the crowd surge shifts to the other doors, and suddenly you discover those doors were never designed for that volume. The result is congestion, price spikes, and frantic behavior. That's how you get silver behaving like it's chasing oil, like it's chasing a strategic commodity status. Because for the electrification economy, it is. Now let's talk about what smart money tends to do in moments like this. Because this is where you either become the calm person at the table or the person flipping the table. When the market goes parabolic, the first goal is not to get rich. The first goal is to not get destroyed by volatility. Silver is famous for brutal reversals. When it moves like a door in a windstorm. People get hurt because they stand in the doorway. So here's how you think like a risk manager without turning into a robot. You decide what you are actually betting on. If you think this is macro-driven, dollar down rate cuts coming, then your key risk is that rate expectations change. A single inflation print, a single labor surprise, or a shift in central bank tone can change the bid for hard assets. We've got November CPI around 2.7% year over year. If that number reaccelerates, rate cut optimism can wobble. If it decelerates sharply, the hard asset hedge narrative can cool. Either way, macro is a dial you must watch. If you think this is supply driven, the key is enforcement and flow. A licensing regime only matters if it slows exports in practice or changes who gets priority. If you think this is a real physical tightness story, then you watch the places where physical stress leaks into public view. You watch deliverable stocks. You watch spreads. You watch whether premiums detach from futures. You watch for backwardation behavior that signals urgency. And here's where I give you the practical plan, not a fantasy. First, you stop treating volatility like entertainment. If you're going to participate in a market that can swing 5% in a day, you size positions like you're driving on ice, not dry pavement. Smaller size, wider tolerance, fewer emotional decisions. Second, you separate long-term exposure from short-term trading. A long-term thesis is not invalidated by a weekly drawdown, and a short-term trade is not protected by a long-term thesis. Mixing the two is how people blow up and then tell themselves stories about why it wasn't their fault. Third, you diversify your expression. If your whole view is silver up, you can express that through multiple channels that don't share identical risk. Some people mix a metal proxy with a basket of miners. Some people pair that with cash equivalents because optionality is power. Some people hedge with the opposite exposure and small size. The point is that you don't put your entire future into a single fragile bridge. Fourth, you avoid leverage you don't understand. If you need leverage to make the trade work, the trade is probably too big for your account. Now, let's go back to the payoff I promised at the start, because you deserve the clarity. Is this the beginning of a squeeze that runs into 2026, or is it a blow off top? The answer is not in your emotions. It's in the scoreboard. The first dial is policy reality. Does the licensing regime translate into measurable export friction, changes in customs flow, changes in who exports, or changes in delivery times? A paper gate that doesn't slow anything is mostly theater. A paper gate that slows flow becomes a physical constraint. The second dial is the deficit math. If demand remains structurally elevated and supply response remains slow, the deficit doesn't vanish just because price is high. Remember 2024's implied deficit around 146 million ounces based on supply and demand numbers? If that gap persists or widens, price spikes are not random. They're rationing. The third dial is deliverability stress. COMEX registered around 126 million ounces on December 26, 2025 is not the world's silver, but it is a public temperature gauge. If that gauge tightens while price remains elevated, the market will act like it's short certainty, not just short metal. Now let's talk about how this hits stocks in a more specific, fundamental way, because I'm not here to give you vibes. I'm here to give you mechanics. A miner's income statement benefits when realized metal prices rise faster than costs. If silver holds even near current levels, revenue per ounce rises and margins can expand, but miners also face costs, inflation, political risk, permitting delays, and operational surprises. So you watch margins, not just metal. An industrial user's pain shows up as cost pressure. If you sell hardware with tight gross margins and you can't pass input costs quickly, earnings get squeezed. That pressure can hit suppliers, then manufacturers, then distributors, then consumers. And the most interesting group is the one that can pass costs because demand isn't. If a product is mission critical, the buyer pays. That's how high voltage grid infrastructure behaves. That's how some defense and aerospace applications behave. That's how certain data center build out behaves. The buyer complains, then signs. So the strategic question becomes, which companies have pricing power and which companies are trapped? A company with pricing power is the restaurant that can raise the price of a steak and still have a wait. A trapped company is the food truck that raises prices and watches the line disappear. Now, take a breath, because here's the most important psychological shift. Silver is not just a trade. Silver is a stress test. It tests the electrification story. It tests the green transition story. It tests the supply chain resilience story. It tests whether the global economy can scale a high connectivity future without choking on a metal that IS&T produce like oil. And that brings us right back to China's gate, because gates are leveraged not because they cut the world off, but because they force the world to negotiate. If you've ever dealt with a bureaucracy, you know how power works. It's not always the person who owns the thing. It's the person who controls the process that gets you the thing. Now you understand why a quiet export regime can matter more than a loud headline. And you also understand why the most dangerous moment in a parabolic market is the moment you feel certain. So here's what I want you to do next, right now, while your mind is clear. If you got value from this breakdown, hit like, subscribe, and send this to one friend who thinks silver is just a shiny metal. Because the people who understand the inputs before the headlines arrive are the people who make calmer decisions when everyone else is panicking. Then build your watch list like a professional. not like a gambler. Pick a small set of miners you actually understand. Pick a small set of industrial users you can track. Pick the macro dials that drive hard asset flows. Keep a simple journal of what you believe, what would prove you wrong, and what you will do if you are wrong. Because winning in markets isn't about being right once. It's about staying solvent long enough for being right to matter. And now I deliver the truth that ties it all together. Silver didn't spike because the world suddenly loves silver. Silver spiked because the world is building an electricity-hungry future while supply is constrained. Deficits are real and a major player. Just installed a checkpoint on export flow right as the market macro backdrop made hard assets attractive. You didn't see it on the news because it's not sexy to talk about licensing regimes and industrial paste. But that's exactly how real power works. Quietly, mechanically, and then suddenly, all at once. If you want to, in the next episode, we LL map the exact chain from silver input costs to specific balance sheets where margin pressure shows up first, and how to tell the difference between a headline-driven spike and a supply-driven squeeze before the market makes it obvious. Until then, stay calm, stay numbers first, and don't let a fast chart trick you into a fragile decision. The receipt's not for voiceover. For your on-screen sources silver price records and the late December spike above $80, plus dollar moves and rate cut expectations.